right, we are live. Hey guys. So, market this weekend has been interesting. I think it was kind of funny. Kevin mentioned a surprise for next week, and in the same breath, my fiance, we have family overseas, and she goes, "Yeah, there's going to be an attack on Saturday." And I was like, "It's Kevin." It's like it's Kevin. He's like, "No,
No,
no, no, no, no. It must be something." I was like, "Okay, okay." I was like, I don't know. I was like, Kevin's that prophetic."
no. Well, I mean, they did kind of telegraph it, but
They did telegraph it, yeah.
um,
And
yeah,
most of the Jewish people knew that it probably happened on Shabbat, so it was kind of easy to tell the time frame. So
yeah, man. It's so yeah. So over the weekend, let's start here, if you will, right? So when we talk about geopolitical events, especially when you're talking about the futures market or just commodity markets in general, it's always best to just stay patient. What I saw, like, and FinTwit's not like the number one thing, right? But like, man, I was seeing all sorts of stuff coming out as far as like spot gold is going to spike to $2,800 because some
yeah,
meme going out there is stable to it or whatever. And I'm not trying to knock the significance of the event. It's a very significant thing. This is something that's been leading up for decades. And we saw the tinfoil hats out there too, like, oh, it's the whole conspiracy for Biden or whatever. Like, no, guys, like this stuff has been an issue for a very long time. And so what actually happened was very remarkable. Iran has not never directly attacked Israel. They've always used proxies in order to do so. Now the thought process is what happens if they try to normalize that type of behavior, which is why we're kind of on edge. The market's a little bit on edge because does Israel respond? And do they respond in kind? What type of response do they have? What's the allyship going to look like? But I don't want to go veer off the course. When you have events that happen after a Friday, and if you guys just kind of notice that we haven't had many military type of an event during the week. They're usually Fridays after the close when things starts to pop off. Just sit back, relax, get your news sources, get them from both sides, and I'm nothing against Al Jazeera, but I like to watch Al Jazeera along with some of the other mainstream on the other side too, right? Try to see which news stories actually align because you get a lot of bad reports that are out there. And then you wait, and then Sunday is when you start doing your homework and you start to figure out, okay, how is the market going to react? Are you still seeing something um, ratcheting up? But don't get ahead of yourself. Don't try to get biased on one side or the other in order to try to make a trade because there's a lot more that happens behind the scenes, Jason, like a lot more stuff happening behind the scenes than we will ever know about this event. We'll probably, by the time that we're 80, 90, 100 years old, we'll probably still get stuff uncovered about this event. So just be patient. Don't overreact. That's a really good time to be able to have your risk parameters in place going into a weekend like that. But I just wanted to kind of highlight that if we had the same type of dynamics that happened on Saturday happen Sunday at 4 p.m. Mountain Time, which would be 6 p.m. Eastern Time, and the futures were open, completely different dynamic. But things changed over that 24-hour time period, and that's why you never want to get ahead of yourself when you're trying to establish any type of trades or come up with any type of market thoughts until you get really kind of closer to the futures open and you see how everything levels out. What do you think? I don't want to get into the political realm of good, bad, or indifferent, right? I'm just trying to say holistically, sometimes events take some time to mature in order to get a clearer picture of how they could actually dynamically impact markets as a whole. Oh, you have to mute.
I said that's the first thing I'm retweeting right now is the significance of what you just said there. Sometimes events take time, and that's the truth, man. You can't really like have an event, look at it the day of, and go, okay, I know everything about it. Like you just don't. Look at 9/11 for example. I mean, Jesus, like we're gonna be talking about
Yeah.
that. That's one of those ones we're gonna be talking about until we're 90. New things come up all the time, and so I think that that's incredibly important. Also, The market action is everything. And I think too many people like this weekend. I mean, how many shares of the weekend Dow did you see? Like you just see shares of the weekend Dow over and over.
Yeah.
And that thing's never accurate. Like people are looking, so a market crash on Monday because it's down 1%. Like it's like no, like you have no idea when the market's going to crash. You have no idea what exactly is going to happen in the market today either. Like you can't say how the open will go. This is why it's important to understand. Like yes, it's important to understand all the reports and on all the events and what's going on. However, you can't predict what the market's going to do or how it's going to react to that. I think that's always the hardest part. The hardest thing as a trader to do is really like to sit on your hands. I think so many people think it's like tradable, and it's like for me, we've had these positions for a while. However, I can't tell you on Monday like our oil position is good. Like how many people, like I got emails from people and clients that were like, man, our oil positions are going to be insane on Monday. I was like, I don't know. You have no idea what Monday is going to look like. It could be a sell the news event. These things happen all the time. More often than not, when you have a big news event, and everybody's going, well, this has to happen with the market because of this, and then everybody gets outsized on their positions going long or something because they're like, okay, political risk is going to happen. Sometimes that's a sell the news event. Yes, it doesn't kill the primary trend. We're still moving up, sure, but like it's obviously stalled out now. Obviously the news didn't take it to a new high. That's telling you something. So once again, it's incredibly important to just sit on your hands during these times. And also, like let's just look at all of the sectors today. I thought that was kind of interesting, and looking at the commodities and so on. When we look at the commodities, oil's down over almost 1.5%. Cocoa's slightly up because cocoa does cocoa things forever, I guess. Orange juice is slightly up. Silver is up, which would be the one that you wouldn't think would be up in this type of environment over gold, especially but silver is massively outperforming gold right now. Copper, that's a growth-based commodity that usually works as growth, something that would signify that growth is going higher in the economy. Copper is also up a ton right now. That's the opposite of what most people would think today. So to me, it's like you just have to take your positions, put your positions on. Don't try to predict how the market's going to react to events. Yeah, you can go, hey, there's an event this weekend. Hey, something's going to happen, but you can't just go, okay, the market's going to crash because of blank is going to happen this weekend. I'll short everything, like it just doesn't work that way. I wish it was that easy.
Yeah, and I think we talked about it last week too, right? Like we knew that something was going to lead up, but it's more important to just really protect your risk. And if you don't want to have that risk over the weekend, either long or short, then close out, right? Like that's the way to be able to manage that. What I found very interesting Friday, last hour going into the close, is that dramatic drop that we saw in pretty much all of the commodity baskets that were bullish long, right? So crude oil had a pretty significant sell-off. What did that really tell me? It told me that managed money was probably selling out of their positions or trying to reduce their position sizing because they just didn't know. Sometimes it is just going to be a wild card. So I thought that was very telling. The other thing that we had happen on Friday too, going into the close, is grains caught a significant bid. And so what that signified to me is that markets that were uber short on the net short side when it comes to positioning, we saw those individuals cover into the weekend. And then those that were super long, we saw them covering on the short side over the weekend, right? They were selling out. So we kind of had like this offset where these bearish markets like grains were actually outperforming towards the end of the day, and energy was actually not doing so well into it. So I think that was also kind of a telltale sign. Now, what's going to happen this week? Here's my biggest focus. 10% of whatever your trade plan is, or 10% of whatever your strategy is, you have to keep geopolitical narratives in the back of your mind, but that should not be your whole thesis on making any type of trade at all. That's one thing that kind of fails people a lot, because the situation is very dynamic and it can turn on a dime. And so this week, what I'm kind of looking out for is the reaction in the dollar. So the dollar was continuing to strengthen last week. Today, it was up over 106 on the dollar index, $DXY for on toss. We're still above that 106 level. which is actually amazing to say the least. I mean, we knew that we would see some pressures going to the upside here, but we do have another flight to quality type of scenario. And I think, something no one's really talking about, some people are, but there is some yen risk that is out there. The US dollar yen pair continues to rise to a healthy clip to the upside when you're looking at the US dollar compared to the yen. And it appears that it might be in some territory where the BOJ may have to take some form of action. Now, unfortunately, the BOJ is in a rock and a hard place because they just started raising their interest rates after 20 years, 25 years of being in this stagflationary environment. So now they have their interest rates pretty much flat, but they're still doing quantitative easing practices in the market as well. So the market has basically called this bluff and said, okay, you're still easing market conditions. We're going to capitalize on that. And that's the devaluing of their currency. Now, that does benefit them in a sense because they're net exporting economies. So that's something that's going to be a benefit, try to spark that growth. The problem that you also have, though, on the other side of that is their purchasing power for their consumers is completely getting wrecked right now, wrecked. And so now you have this dilemma between, do they try to save the currency or do they try to save their treasuries? Either way they go, they're in a rock and a hard place. They're going to have ramifications for that. But I think keep your eye out on that dollar. Now, the yen is only about 14 to say 17% of the dollar index. But I think that's another reason why we are seeing some pressures going into the dollar. Obviously, a little bit of flight to quality from some of the other currencies as well. But that dollar strengthening is just a headwind when it comes to equity markets as a whole. And then also when you're looking at commodities too, a 106. I mean, to say that the dollar would be at 106, where a week and a half ago we were looking at it at 104, and to say that crude would still remain roughly around 84 and a half to $85 is remarkable, because usually a higher dollar also then creates this inverse relationship where energy prices for the most part go lower. So we are seeing some technical headwinds when it comes to the energy space, but I'm keeping my eye out on that. I'm also keeping my eye out on RTX or Raytheon. Once again, the geopolitical nature that is out there, but here's one that is actually fundamentally, and this is not a recommendation, but just keep your eye on the price action. Now that Iron Dome is actually developed, or was co-developed by Raytheon. Now it's called RTX with Raytheon, right? And then there are also the ones that actually develop and manufacture the Tamar missiles that actually go for that system as well. They used a significant amount of those this weekend. There's definitely some fiscal policy that's going to be coming down the pike here, definitely in the United States, probably for some other allies, and that could actually be a net positive for RTX when it comes to orders, right? Now that would be like one of those buy the rumor, sell the news type of an event, but that's another stock that I'm kind of keeping my eye out on. And then the last thing is the Brent crude and oil and WTI spread. Mm-hmm. So over the weekend, as you talked about, everybody's like, oh man, oil's going to rip, oil's going to rip, oil's going to rip. Here's the thing. No one knows, but a good indicator that you could see strengthening demand for American produced oil is going to be the difference between that spread. Whatever the difference between the Brent crude and WTI spread is, as that spread gets smaller and smaller, that signifies that demand is actually growing for United States produced oil, right? That'll give you that indication of strength, where then price action will then, also reconfirm that to the upside. But if you see that spread actually widening out, that's where you would get a little bit cautious. That would be where the geopolitical news on the headline front can create some reactions, but the fundamental basis for a move or a sustained move in crude might not be there. And so that's what I'm keeping my eye out on as well. I'll send you a chart if we want to post that up. But those are the three areas. Dollar, looking at RTX just as something to notice from a price action standpoint, and then also looking at that spread. The spread really gives me the guidance right now where we see directional flows going in for crude as a whole. Without that spread, I think it's going to be very hard unless we wait for industry data to be able to back or confirm demand spikes or demand lulls. And I think that once again, that's an area I'm keeping my eye on.
No, I love it. That makes a lot of sense, and all the picks are really good. I mean, not exactly. Obviously, you're not giving trading advice, but at the same time, like, places to pay attention to in market environments are incredibly important. You can't just look at it and go, well, this is what's supposed to happen. Let's look at what could happen, let's try to figure out how we would position ourselves if these things start to happen. And then let's wait for the price action to give us signals that we're right. Because really, that's a thing we all have to really wait on all the time, is seeing if the price action is signifying anything. I think the thing that's incredibly important is the fact that things like silver, the growth based things have continued to be strong. Like gold has a monetary aspect to it, which is why it has a premium to silver most of the time, which is why it's one of the only commodities that really is like trending most of the time. It usually moves up over time. The rest of the commodities, if you look at it, they go through huge boom and bust cycles, but gold has a tendency of not doing that as much. But if we look at silver, it's on the other end of the spectrum. It does have some monetary aspect to it, sure, but it also, one of the main parts of silver is it's used in industrials quite a bit. So very similar to copper, very similar to palladium, and so on. So silver has a bit of a premium to these other two things that I just listed, like platinum, copper, even platinum. But at the same time, you can't just look at it and go, okay, well, silver has to go up because of blank, and gold has to go up because this event happened. Like, if this event was triggering something huge that was panicking the world, gold, you would say gold must go up then. I think the way I look at it is in a different way. I think there's global strife, there's turmoil happening. We've known that for months. All of a sudden, gold breaks out, starts moving to new highs. Most of the time, when the event happens, with the big money that already knows that the event's going to happen, for the most part, this is why we use price action. They're already in there. They've made their money, and on the event, they're usually selling out. This is what creates the cycle of the sell the news event. So I think it's incredibly important to just digest that, so you're not always chasing the action. I can't tell you how many people were like chasing the action today or chasing it last night. Hey, the market's going to crash in the morning. All these things. The market ends up opening up. Granted, yes, it's on a strong day. Yes, we gave some of the gains back already, but at the same time, it's like you just can't know. Like, if it was really an event that was going to take the market down, you'd have saw a huge gap down today. Below, I mean, we were there. We could have literally just gapped below all resistance and just gapped back down to 5100 and just kept falling and falling for the next week. And you could say, hey, we're going to go into a big correction or a bear market or whatever. But what we're seeing is something different. And I think when we see a little bit of resilience in the price action, that's usually constructive. But once again, I wouldn't call anything right now. I need to wait to see the close. If we continue just falling down, that's going to be wrong. Then we have to look at it like something bigger is at play. And then if the market holds up here, we get a decent close. Right now, I wouldn't say this is a decent close if we close here. Get back up to those levels that we started at the beginning of today. And then I would say that's a decent close and could lead to some strength going into the end of the day.
Yeah, I agree. So last week we were talking about producers selling into the strength, and that type of that position has been taking place. Let's say at least here. Now, silver continues to rise to the upside. It is outperforming gold that you kind of talked about. But once again, silver has that industrial property to it, and so the industrial metals, or those that have industrial exposure, continue to see a fair amount of strength. Also, the currencies that have industrial exposure to, or manufacturing exposure, or these AM type of exposures, are also catching a little bit of a bid as well. So that's something to kind of keep in mind here. Silver still has that hurdle, and I still am going to say I think it is still a hurdle between 2750 and 2850. We're trading above that right now, where we're at 2866. I think there's still a very big hurdle there. That gap range all the way up to, say, even $30. I know that's a very long range, but I would say the previous one is kind of what I highlighted last week. I'm going to stick to that. That's a hard battle. That's going to be a very hard battle. But if we have strong economic data that comes out, like retail sales today was on fire, those industrial metals are going to take up, continue to potentially pick up and then gain a little optimism here. Let me also just kind of talk about. We talked about liquidity last week too. I think that's a huge factor when you're seeing these gap up and gap downs. Like, we are reversing this move right now. It looks like we're trading at new lows for the S&P 500 in today's session, at least. The liquidity still has not come back into the market. Okay. We're still seeing some relatively low size on bid-ask spreads for the E-mini S&P 500. That's what I utilize to judge liquidity. We would want to see that in the 75, 85 contract range on the bid-ask, and we're just not seeing that. So these gap type of markets or these range-bound markets can be very aggressive to any type of trader. If you're long, if you're short, so you have to just be mindful of that. And somebody also kind of called out too. There's usually a second shoe to drop in these type of events. That is true. It does take some time though sometimes, right? It's usually not like 24, 48 hours after. Sometimes it gets to be a span of 3 months or 6 months. I mean, if you look at the October 7th situation that occurred, look at this escalation that took place now, based on all the things that have occurred over the last, I don't even know how many months that is, 6 months now, 7 months.
Yeah.
So some things can take some time to be able to develop here. So yeah, that's kind of where I'm at with when it comes to the metals. Just kind of like keep your eye on them. I feel like we're still going to be fairly range bound. Nothing has changed as far as the structural positioning on an aggressive basis when it comes to silver. We continue to see producers selling into strength, which is what they're supposed to do. They're supposed to hedge. We still see speculators incrementally getting long. The speculators have commanded the price action now. So that's kind of where when we talk about these particular levels, we talk about the structural foundation in order to get up to those levels. What is the macro talking about? What's the data points looking like? What's the price action? What's the positioning under the surface? What can make the case to get to a price level? And then once it hits a price level and speculators take over, then it's off to the races, right? Like then it's like, who knows? Because that's once the speculators get in place, that's late cycle behavior. And when you talk about late cycle, that doesn't mean that the market has to just completely bottom out whatever type of market you're looking at. That just means that expect choppy action, expect a lot of volatility here into the space until a new structural or foundational catalyst reemerges. Whether it's demand data for gasoline, whether it's operating rates actually reversing and moving lower, whether it's drawdown in inventories, that type of structural data to be able to give yourself a little bit more of a thesis for a catalyst, a continued catalyst to the upside or downside. Right?
Oh, perfect. And if you guys are on Twitter, make sure to get over to YouTube. That way you can talk to us. We have a ton of people on Twitter and barely anybody on YouTube. And YouTube's where you can live chat with us. So make sure to get to the YouTube channel. It's all AAO Research. So at AAO Research for Against All Odds Research. You can find us there. Definitely come talk to Kevin and I. But yeah, let's get back to this one. So great analysis there. Let's get back to this one. We touched on this earlier. You just sent me the chart. I just saw it, and I was like, we got to talk about this a bit more. So what are you seeing here? Explain it to the audience once again, Kevin.
Yeah, so this is just a high-level overview. This is the Brent crude prices minus the crude WTI prices, okay? So it just basically shows what the difference is. I have it on a 3-year weekly chart because sometimes aesthetics mean everything, right? If you were looking at it, you would probably want to look at it on a daily chart because that's when you're going to get the underlying internals. You can actually see that price action. But what this really shows, if the price or that line goes to the upside, that means that the spread between Brent crude and WTI continues to expand. There's a difference between price because of transportation costs, storage costs, carry costs, all of this other stuff, right? And then because when you export oil from the United States, the transportation of that oil usually is going to be done through ships, right? So Brent crude always has that advantage for the global markets rather than the United States. But if you see that spread move to the downside or that line move to the downside, that would mean that, imply all else being equal, but it would imply that demand is starting to pick up. That spread going lower, I wish I would have, now I think about it, I should have overlaid the price of crude. That spread going lower also coincides with prices advancing, right? And so we kind of have that inverse relationship. So you want to see that spread. If you're bullish on crude, you want to see that spread go to the downside. You want to see it contract. That would give you a little bit more of a bullish thesis. If you're bearish on crude, you want to see that level really expand. And that'll actually kind of signify that maybe export demand is not as robust as maybe the headlines are trying to suggest. So that's pretty much the thesis there.
No, that makes sense. I mean, it's crude is just going to be the most interesting thing, in the market always, and for a couple of reasons. One is it really tells you what environment we're in. Two, you can tell a lot from the spread by where to be positioned and how you need to be positioned in the futures market. That makes a lot of sense too. And also, you can figure out how producers are probably going to start hedging themselves or positioning themselves going forward based on the spread. So once again, this is a good chart. It's a good template to kind of look at to go forward. I just think for me, I think there's so much going on in the world, so much risk to the supply at the moment. And not to mention, when the trend is up, this is when most of these things kind of happen. So I'm still bullish on crude. At the same time, I'm also going to say, like, when you see a big event like this and that's kind of the top and it kind of tops, I want to pay attention there. I want to, also wait for a possible reversal there. I also remember, many times in the past, if you've traded crude for a long time, the one thing that you'll see a lot is these massive blow off tops.
Yeah.
Go back to 2019, I think it was, Saudi Arabia. That was a huge one. We had this massive blow off top. I think that was at the beginning of 2020. So we had this massive blow off top. The market basically made a 2B pattern. Basically what that is, where it breaks out one direction and then comes back down the other direction, and basically topped right there. And that's when it went all the way to negative, basically. So, for me, I want to really pay attention here. But also I know that the crude market, most of the time when you see weak price action around events, it's not as bad as you think. But once again, it doesn't mean what I'm saying is completely speculative. I think I need to keep watching the levels here, and that's what I'm going to keep doing as a trader. I'm going to watch for my exit signals, watch for my stops. And if we look at crude just straight up, I mean, it's still hanging out around that $85 level. For me, that's still pretty bullish. I think it can move. It can still go higher, but also pay attention for lower. I think if we start to get our stop is around that $80 level at the moment. If we start to move below there, I'd absolutely be out of my trade. It's a long-term trade, so possibly more upside, possibly some downside. But once again, you have to just continue to pay attention to the price action, continue to pay attention to the geopolitics. Most of the time when there's risk out there, that's the biggest thing we're looking at. So is there still risk in the world and in geopolitics? And I'd say yes at the moment. And so if we're looking at that, watch the price action to see if it starts to move back up again. Watch for breakouts. Like we talked about last week, if I was trading crude today, and let's say I had no position, I would short it, under that, let's say I would go short long-term under that $80 level, but I would go short in the short term right under this $84 level. Like, so you're pretty close to a short in a short-term trade. For a trade to the upside, I would just wait for it to close above 87.20. If it closed above 87.20, then I would get long it again. So really, like, it's a lot of sitting on your hands right now and waiting for the price to kind of confirm a move up or down at the moment.
Yeah. I'm right there with you. And once again, I mean, we've had a nice little bull action here on crude. It's in an upward channel. We haven't violated that channel. And so seeing a pullback is not outside of the realm of possibility. And actually the lower end of that channel range right now, to keep it intact, actually goes down to 78, 71. And that still would be a bull market for crude, right? So I think once, respect the technicals there, a pullback is not outside of the realm of possibility. And I think there's, once again, some green shoots when it comes to the data. The only thing I would say is a little bit cautionary for me with the EIA data last week. We saw operating rates make a marginal increase, nothing to write home about, but you did see gasoline inventories actually build. And so the question will now be out there. We won't know this for another couple of weeks of data, but now the question is, have we met the demand need for gasoline right now? And are the refining rates already reflecting that? Have we focused so much on gasoline that now we've met that demand that's out there? Do we see stabilization in those prices? And then on the back half of that, Do we see a heating oil or diesel, really just diesel, but they're both the same? Do we see heating oil and diesel be neglected from a refining standpoint? And could that actually shore up or reduce supply that's out there? And do we see a catch-up trade taking place? That's another area that I'm kind of looking at right now. But like I said, it's been a nice run. You don't have to dynamically change your thesis because you get antsy. I think this is kind of where we fall in line. And if you take the geopolitical nature out of it right now, you can make a case that oil could trade between 80 and 85. You add some geopolitical spice in there, and Jason, if you look at it, the news headlines, these spikes are $1, right? It might be sliding 84.50, and then it pumps up $1 once we have a news headline. So that also implies maybe it's only $1, maybe $1.50 of geopolitical premium really being priced in right now. Either way, so that's where I think the range still stays intact right now. I don't have any reason to adjust that thesis.
Yeah, I mean it's and also looking at heating oil being lagging here kind of is saying something too. We kind of look if you look across the board, and also gasoline. I think what you said is also significant. We just kind of have to watch these things across the board at the moment. I don't see any reason to go, hey, this is over here. I see more reasons to go, hey, I wouldn't be surprised if we chop sideways here for a while.
Right. Yeah.
That would make perfect sense. It'd also still be profitable for producers. It would still be, it would still hold up with the thesis. And also, we're going to need to see probably a catalyst for a move higher or lower. And that could be a catalyst, a forward catalyst, meaning not today, not next week. I'm just saying something that people are looking for going ahead. And really, let's look at the global economy. Like we're in the United States, we're seeing a lot of kind of a slowdown if you're looking at the real world. This is the problem I'm having with the oil thesis on the fundamental side. Even though I'm a price action trader, even though I'm going to put on my positions based on my signals, I'm also having a problem looking at just dwindling demand in gasoline at the moment. A lot of people are struggling. A lot of people are not interested in going on trips or vacations quite as much at the moment. Rates are very high. Some of those things would need to change for us to really see some significant demand in gasoline at the moment. I just think people aren't spending like they used to. Not as many people are really having to kind of hunker down at the moment and just go, okay, what do I need to do right now? What do I need in my life right now? I've even talked to people that are like, hey, I can't do certain events with my kid anymore. I can't take my kid to traveling leagues anymore, any of those things, because I'm driving and driving costs so much and so on. So it's like at the moment it's kind of tough to see. But once again, I always talk about there's two different things, and when we're trading the markets, there's the real world, and then there's the market. And so the real world, think about 2020. You're basically looking at the world ending. The markets crashed. When did the market bottom? Well, when we started to shut down, the market bottomed right around that point. We shut everything down. The market bottomed. It started going higher. Every single thing that was basically against the market only drove it higher at that moment. So once again, it's important to understand these things and understand the market's going to react differently than the rest of the world. But at the same time, understand that when you're trading, you only make money through the price action. You don't make money because you see what the world's doing and you've decided to make trading decisions based on that. The market is very forward looking. And so it's screaming growth right now, which I don't understand personally. But that's not for me to understand. I'm just saying, hey, price signals are all up. Copper continues to just rage higher, which is very bullish for growth. And most of the time when that happens, if you run a model and a back test, you can see that copper usually it hints at what's going on in the global economy. This is why we call it Dr. Copper. And so looking at all those things, I could see gasoline and oil prices going higher. I could see a lot of pressure on inflation. Somebody said the other day in one of our reports about the fact that they were talking about the fundamentals and just the fundamentals of supply and demand and how commodities work. And I had to say, hey, well, when you look at the market, you have to also understand there's many things. Like there's the macro of it. Yes, there's supply and demand. There's all these things, but you really have to understand also what's liquidity like globally, what's happening with the dollar. All of these things are going to matter over time. Now, once again, yes, intermarket analysis, meaning the dollar against oil or something, these things can change over time. The correlations can shift and move, but usually what we say is those jaws close, meaning when you have two things that are really far apart from each other, the jaws come back together and the correlations start to step back up again. So I don't know exactly how it's going to look in the future, but I can say that, keep an eye on the dollar. It's always the most significant thing that we're all watching all the time. And keep an eye on growth based commodities like gasoline, oil, copper, and then also the safe haven trades, like bonds and gold. If you can continue to watch those things, you can figure out how you should be positioned and how you can kind of make money in this market, whether it is choppy or strong or just trending.
Yeah, I'm right there with you. So for gasoline right now, what we can estimate is daily consumption, and I'm gonna give you kind of a wide range, but daily consumption sitting around 9 to maybe 9.3 million barrels a day, right? But on the week-to-week basis, over the last 3 EIA reports, we are seeing that kind of decline. And the way that you can kind of measure that is the amount of refining activity that's taking place, or the inputs for the refiners, and then you take the product supplied, whatever they are actually able to refine, and then you take that and subtract that by whatever the inventory build is, right? Or if there is a negative number on the inventory, you can add that in. So around let's say 9 million. So if that stabilizes, I think that gives you a good price support for a gasoline. But if we start to see that deceleration or that decline starting to gain a little bit of steam, then that's where you would be a little bit cautious. We're not there yet, right? We're not there yet. We just have to be cautious about it. And I think that's exactly what you're talking about.
Yeah, so I just saw your couple more of your charts that you just sent me. Yeah, I'm gonna bring those up in 1 second. So in 1 second. There's so much here. When do you have to go, Kevin?
I'm actually free for the next 30 minutes, 40 minutes.
Okay,
So,
cool. We'll get going until 1. All right, so let's look at this one.
Yeah.
So you sent me this. This is interesting. So go ahead and explain it.
So in the piece that I wrote for this week, I really try to stress you want to focus whatever commodity it is, whatever commodity that you have. We can always talk about some demand side, but that's not really what you focus on in any type of geopolitical event. What do you want to focus on is going to be the logistics lines that are out there, right? Transportation, and you want to look at the supply side as far as supply infrastructure, right? So what could be targets for Iran? Israel could target Iran oil facilities, their extraction capabilities, things of that nature. What could Iran do? Iran can actually try to constrain flows of ships within the Strait of Hormuz, and that's a bigger deal than the Suez Canal. About 3 or 4 times bigger deal than the Red Sea at this point. So that's an area where you could see them actually focusing on if they wanted to try to put a little bit of pressure on the West, put a little bit of pressure on Israel and others. That's an area. So if you start hearing the Strait of Hormuz more and more, and you hear escalations around that area, then that would be a bull case for crude, because that's where a lot of that flows go. The other thing to also note too is that there are in certain pockets there, exposure to oil or energy infrastructure for some of the biggest names in our market, the Chevrons, the Exxons, so those could be also an issue, to say the least. I believe a lot of the locations there are going to be petrochemicals, and then if you're looking on the other side, Towards Egypt, they also have some refiners at the tip there as well. So that's, once again, I just bring this data up, and I'm not trying to fearmonger anybody. I'm just giving the data out there. If you're going to see a price spike in energy prices, it's got to be either the supply methods or the supply infrastructure that's out there, which is going to be the oil refining facilities, the extraction facilities, or it's got to be the transportation side. Those are the two things that you focus on. And I think the bigger risk right now would actually be the transportation routes rather than hitting oil facilities. And that's because the United States is definitely trying to probably, put some pressure on Israel and say, hey, don't hit those facilities, just like they did the same thing for Ukraine, right? Because they are concerned about the oil market. I also want to address something too. Over the weekend, how quickly we see narratives just spiral out of control. Over the weekend, now people were talking about, are we going to start depleting the SPR again because of this event? Like, we are nowhere near that, guys. Nowhere near hitting the SPR levels, even with the price of gasoline where it is right now. Yes, it is expensive, but we're not at $4.50, $5 a gallon levels yet. That's where you would see as an emergency. And unfortunately, this is also another political year. And I think the Biden administration taking the action of depleting the SPR outside of a major disruption in supply chain, just because they are seeing inflation kind of just move to the upside, I think that would be a policy error, politically as well as strategically. And so that's what I wanted to kind of call out. That's the Strait of Hormuz that we are focusing on. The one below that has those ships, those red ships, that's the Suez Canal leading into the Red Sea. So those are the two areas. The bottleneck at the Strait of Hormuz could be very detrimental. Saudi Arabia, major exporter, Iraq, exporting, Iran exporting. What do you got? Oman over there export. So all of those are exporters, net exporters. So that's the focal point of that chart.
No, and that's incredibly important, because I think that this the first thing I ever learned when I started to do analysis for farmers, which was that commodities markets are supply side driven mainly. So basically, you can kind of figure out what's going to happen with the price as you're really analyzing the supply. So really, you have to pay attention to that. How's the supply chain? How does the supply chain work? Well, you have to focus on the logistics. Think of any company that you're looking at. Basically, you have to understand, especially any transportation company that you're looking at, you're going to have to really understand how their products are getting out there, what they're doing, how can you move these products, and so on. So once you can understand those things, you can kind of figure out what the market's going to do. And so I think there's just so much going on right now in this area. And it's very similar to what we saw in history in that area, the 6 Day War with Egypt and so on. Like, historically, we've seen this happen before. So we need to continue to pay attention to them. The thing that I'm also always looking at more than anything else is, what's the environment? So when the environment is very inflationary, that's the first thing I'll always start with, because I'll go, okay, well, I can do all this fundamental analysis. I can kind of figure out these things, but is the environment conducive to oil moving higher? And yes, it is, because I think part of that is, yes, there's all of these macro factors that matter in supply and demand, and micro factors that matter. But I also see a lot of it as psychology. The psychology of market participants also matters. And so when you put all those together, yes, oil, energy, all this can move a lot higher. And then we dive into the fundamentals and come up with a basic scenario for it to happen. This is a really good podcast if you're trying to learn how to trade commodities, to just understand and get in the mind of a commodities trader how they're going to look at these markets and how to position themselves to make money. Kevin gave you a great template there to go off of, so I hope everybody kind of paid attention to that. So if we're looking at all these things, Kevin, let me pull the banners off of this. So if we're looking at all these things and all these different markets right now, and we're kind of seeing that the commodities are raging at the moment, let's talk about the ags, the underloved ags, which I'm starting to get to a point where I'm going, the price action signals continue not to give me any signals. However, all the fundamentals are screaming higher prices in these areas. What's going on with the ags, Kevin? Let's talk about it.
Yeah, let's talk about that. Okay, so look, let's talk about the developments, make sure everybody's on the same page. 2 weeks ago, we had the prospective plantings report that came out. That report showed that farmers are going to be focusing more on soybeans this year and less on corn. So we actually saw a buildup in the anticipation of planted acreage for soybeans. And then we had a reduction in the estimates when it came to the amount of corn that's going to be out there. Okay. So that was kind of the first thing. We saw a little bit of a jolt for corn for a little bit, but then we saw it kind of sliding a little bit more. Then we had better than expected weather forecast for the 14-day forecast starting last week. That also put downward pressure on prices because we might start seeing early planting season taking place. The earlier that farmers can plant in a season, the greater the opportunity that they could also do like a booster crop towards the end, where they say, hey, maybe I can squeeze out more alpha out of my land. And they kind of just YOLO it and say, if it works out, it works out. Maybe I'm not going to get the yield that I would expect in a normal season. But if I yield, say, 60% of total crops planted and the other 40% are destroyed, I'm fine with that. I'm going to top off my silos and I'll hold off until prices actually hit the market. We are also seeing harvest season right now in Argentina and Brazil. Here's the curveball yet that the market is not priced in. So here's the disconnect. The ending stock inventories for the United States were actually adjusted when you're looking at corn, and they were adjusted to the downside, right? So they're thinking less inventory, or ending stock inventory, which means that maybe demand has been able to go up. We've seen some decent export numbers when it comes to corn. So that's the case. The USDA has also hasn't updated their forecast of what Brazil and Argentina is going to do yet. But Brazil did. And Brazil moved their corn expectations as far as harvest, their yield, down because they are having some issues. Argentina is actually having a pretty decent crop, but there's also their risk out there. So I don't have the exact number, but it's around like 18 million bushels, I believe. 18 or 20 million bushels spread between what the USDA thinks, which the USDA is on the higher end of the inventory, and what Brazil's equivalent of the USDA is, which is like COAB, right? So the market has like absolutely no clue what the actual number is going to be, which is going to increase volatility in these products. But they're going on the cautionary side of, okay, maybe the USDA is right at this point in time. If the USDA is wrong and the USDA does come in and actually adjust their the crop or the harvest numbers for Argentina and Brazil to the downside, that would actually be bullish for grains. We also have a problem with the dollar. So the higher the dollar goes, the higher price on a nominal basis. All of our agricultural products, all of our products, doesn't even have to be ags. It can be energy, it can be live cattle, whatever. They become a little bit more disadvantaged on the global scale when it comes to export demand. So prices are already cheaper in Argentina and Brazil. Our dollar is also higher. China's buying more from Argentina and Brazil. They don't want to really buy from us that much. So that's also having a downward impact. But we're early in the season. And we have, if we go to El Nino to El Nina, which is expected to happen here in the next couple of weeks, who knows what actually can happen. So, for instance, I'm out here in Colorado. We don't have that much of an ag play per se, but we do have a significant amount of cattle. Our cattle industry, I believe, is like fourth in the nation, if I'm not mistaken. But right next to us is Nebraska, which is where you get into corn country, you get into wheat country. If you go kind of to the south, Oklahoma. We had 84 degrees yesterday, 85 degrees yesterday. We're about to have a snowstorm tomorrow for like 3 days. Okay. Those are the type of dynamics, those weather shifts that are really unplanned that can mess up an early planting season. So it's really at risk of that farmer. Do they want to try to plant early or do they not? Because if they plant too early, then they can actually damage the seeds that they sow into the ground. So I think that's going to be our balancing act for right now. Let's figure out how Brazil is going to finish up. Brazil is already like in the heart of their harvest. Argentina is just getting into it, so it's going to still take some time. But we have low prices right now. I think that the risk reward ratio up to downside risk for grains, I think, is still favorable to the upside. So even given the dynamics and the inventory levels, and inventory is high, silos are packed to the rafters. Mind you, I understand the headwinds that we have out there, but it doesn't take much. It does not take. You were just talking about what oil and geopolitical risk. Yeah, it doesn't even need to be that extreme. It could be a drought for 3 weeks that could throw off the whole schedule near germination season. It could be a snowstorm that comes in and just completely destroys crop. It could be wind, especially when you talk about Nebraska, and that just completely takes out wheat products. So it doesn't take much. Once again, I think the risk reward ratio, based on what we are seeing for weather forecasts and the expectations moving forward, the drought conditions that we did have over the winter time, I think there's definitely more risk reward that's out there. And I think those short sellers that we saw on Friday covering their positions going into this weekend was a telltale sign for me that they're maybe getting close to the paper hand side, and price levels might be getting less attractive for them to continue their short position. What do you think?
Great points. And also, guys, I know there's a ton of people on Twitter. There's not many on YouTube. You guys can chat with Kevin and I on YouTube if you guys hop over there. I did drop a link on Twitter. But yeah, I think the craziest thing to me is always when you see. So once again, just to confirm what you said earlier, all of our farmers that I've worked with forever, same thing. Their silos are full. They're sitting on all the corn, as much corn as they possibly can at the moment, and that's going to just probably continue and only get crazier if the prices stay down here. No good analyst worth their salt at the moment is saying to make sales right now. Nobody.
On the physical side.
On the physical side, yes, because there's no reason to do it on the physical side. So basically, you're talking about supply is going to start dwindling at some point. And so when supply starts to fall, we're obviously going to have a raise in prices. And like Kevin said, it could be anything could come up here. And there's a lot of risks in South America at the moment. There's a lot of risk, and not to mention in the United States, this is a very early spring. What if we have a frost, right here, right now? That would really, they're already planting, everybody has already went out there and already started planting. You can basically put that under the ground at the moment. You can seed now, but they're already sprouting because the weather's been so nice. So because they're already sprouting, if there's any frost risk that happen, the market is screwed at the moment. So that would just cause the prices to rise. There's just so much risk out there, and the prices are so low that, like Kevin said, I also want to echo, which is the risk to reward for more upside than downside. I mean, it's high. So corn also, it's sitting in a great level right now. And I was going to make a report about this today. I started to make the charts already. But if you look at corn and you pull up a chart of corn, I need to pull one up too so I can look at it and talk about it with my brain attached. Why can't I find corn? Okay, there it is. So if you look at corn, the one of the signals that I like to look at more than anything else as a trader is a band squeeze breakout. That this is one of the best signals. It will whatever trader you are, short term, long term, day trader, whatever you are, this will raise your trading to the next level just by understanding how the signal works. Basically, when the market gets in a very tight range or a commodity or a stock, whatever, and right now we're looking at corn, it's in a very tight range. So that means there's very low volatility. It means the Bollinger Bands will squeeze, or however you measure volatility. You can use an implied move too. So as that's squeezing, you're basically saying, okay, there is no volatility. This is very rare. This very rarely happens in commodities. This isn't something that happens all the time in commodities. So as we're seeing extreme band squeeze, and this is, we could look at this on a weekly chart, a daily chart, whatever. We're starting to see extremes in the band squeeze at the moment. We're starting to see major extremes, and coming out of these major extremes in commercial buying, which is also a very bullish signal. There we have about the same amount of commercial, actually more. Sorry, commercial buying is actually higher than it was back in 2020, which is wild. So you put all that together, we have a setup here for a major move to the upside in corn. However, for me, I have to continually wait for these price signals. Um, so I'm gonna wait till we get above 450. We get a close above 450. I will be buying the crap out of corn. I will probably usually I end up going to the December contract most of the time. So I'll be buying the December contract in corn, and that will probably have a nice move higher. But once again, it's like corn, soybeans, wheat. I don't really have a great fundamental bull case for wheat at the moment, but soybeans, corn, I absolutely do, and wheat will probably follow if those things do happen. Um, but yeah, I just looking across this entire market, there's just so much to like, but all of it's just hanging out in this very very low area at the moment. Prices are still low. It's continually moved sideways. I'm sure people are getting frustrated, but once again, this is how good trades happen. Think about gold. The fifth breakout means is when everything happens. That's honestly how trading works all the time. And there's a great Paul Tudor Jones quote. I think it's in Market Wizards. Jack Schwager talks about him calling market turns, and he's like, "Yeah, it doesn't sound that cool to say Paul Tudor Jones on his fifth attempt catches the market turn. It sounds much cooler to say Paul Tudor Jones shorted the top of the market." And really, the why that's so significant is because most of the time it's not going to be the first time you see it or think it or that trade's going to happen, which is why so many people are getting frustrated in the ag trade. It's going to be later. And right now, everybody's frustrated. The farmers are frustrated. Everybody's frustrated at the moment, and everybody needs to make money. So this is usually when these big market turns start to happen. And also, we're starting to see a little bit of pressure come off in the other areas. Like the meats. The meats are fine, like live cattle. Prices are finally starting to fall.
Feeder that was a contract change too, right? So that's kind of there is an inherent nature of that contract that flows over, right? Because it's the first wave of supply actually hitting the market on the cattle side.
Yeah.
So you usually do see that dramatic drop, but if you go to a seasonal chart, you see that dramatic drop and then corrects itself usually like 3 weeks later. So I think this is a
so I did do that seasonal work recently, and so it's true, but there's one part of it that isn't as true. So it does sometimes last a long time. So we can get a little bit longer on this. We can get a little bit long in the tooth. Not saying like let's say time frames, because we're both talking about two different time frames right now. So you're talking about immediately turning back up. I'm saying it usually ends up the trend changing in this area usually. So I'm not saying it's not going to go back up in price, but start to make new highs and just continue to break out new highs is probably not going to be seen. And that's more what we need to see corn and soybeans start to tick up. So I think that cattle could stay high. I don't think it's going to come down and get hit by any means to some crazy level. I don't think it'll look like corn in a month or two, but I'm saying that we need to see these prices kind of start to consolidate here to actually get corn to start to move higher. I think that's what's been the constant pressure on this. So if we can see those things, that would be something. But at the moment, you could see a little bit of a move higher, which I think would put our thesis, if we kind of work together on that and put both of our ideas, corn moving higher, when it usually does move higher a little bit later in the year, would make a lot of sense.
Yeah, and then you're leveraging that DEES contract too. So there's like that seasonal lever that you're trying to capitalize on as well, right? As you have inventories getting depleted throughout the winter months, those tend to be, for the most part, somewhat more beta-driven contracts when you're talking about the DEES contract. So yeah, for sure. Like I said, it's risk reward. Like going into this, I mean, I think the weather events alone, I think is enough risk reward there to say, yeah, there could be a play made. You add that onto the positioning from speculators and managed money. That's completely. I'm not calling them offsides because they're right, but any type of jolt to the upside, any type of 150 point move, right? 150 cent move, $1.50, like a quick one, right? One of those intraday and just boom, limit ups could spook enough people to get out of those contracts. And I think that could be another catalyst move to the upside. So I'm right there with you. The other thing to note too, and then we can wrap it up, but because we haven't talked about this for the grain trade, and people will remember this. You're out in the Midwest. I used to be from the Midwest.
Mhm.
If you notice towards the end of the year, not even the end of the year, middle of the summer, let's say July, what has been the problem that we've had over the last 2 to 3 years? I'm gonna ask you that question. And then
The drought.
yeah, but what comes with that drought though?
Blight.
Mississippi River, transportation, getting the
Uh,
barges.
I
That
was
has
thinking
been a factor
myself.
lately. So
Yeah.
keep that on your radar as well. I forgot which organization now has a really good chart for that. Once again, we're not making a call, but that has been a very big problem. And if you can't get your grains to the Gulf, you got a problem. And now some of that grain can sit on barges until they try to figure it out. And they've been trying to, dredge up those channels. But once again, there's a risk there that a lot of maritime companies right now probably don't want to take any risk, regardless. Unfortunately, right? Red Sea risk, or even if it's trying to take a chance on a fairly low water level for Mississippi. So track those levels going from St. Louis down. That's going to be a key area, right? Because you're going to get the grain belt from the top. They're going to utilize their transportation resources to get it to the Mississippi. Then the Mississippi is going to bring it down to basically the Gulf. Then the Gulf is where, boom, everything gets transported out, and it can go to the Atlantic, or they can go through the Panama and go to the east. Right? That's how majority of the stuff's being transported. So that's also another area that could be a potential risk. Once again, fairly light winter for y'all in the north. Not a lot of precipitation. If you're looking at Minnesota, you're going to be praying that you get some rain. Every ag person is going to be praying for rain. And unfortunately, if you get too much rain, that's going to be bad for your crop. But you got to get your transports down. And that's been an issue over the last 2 years, last 3 years, that can also put pressures to the upside. So once again, risk reward ratio,
It's there.
It's definitely there.
It's there, and everything is just set up perfectly for, either a summer rally or a, early fall rally. It's more for me right now is continually to just kind of sit on it, watch the price action, take the signals as we cross these major levels, because to me it's not really worth it just to go, hey, I'm going to buy. I think it's going to move up. I do think it's going to move up. I have everything in me that's saying, hey, it's going to move up. However, I only get paid on the price action. So
Right.
usually these levels, why they're significant, isn't just because, hey, there's resistance and support here. It's also significant because these are the level. We also have to look at the levels that the farmers are watching. The farmers are watching those levels like 450 and so on. So when you talk to them and you have these conversations, like they're going, okay, well, this is an interesting level. I'd make sales here. Like you have to start to think like they do sometimes. And when you can really do that, you can still start to understand. I really am giving myself away as a Midwesterner here, but it's the truth, and it really is helpful to just understand. But on the subject of our winter was we barely had one. We had annual flowers, annual crops that should have lived through the winter that just lived.
Wow.
I mean, it doesn't make any sense. Like it was that light. So, I mean, it was crazy. We actually had I have all the bee stuff, and we had bees in December and January. Like you don't see bees out at that time. So it's just we didn't have a winter. We didn't go skiing. We didn't do anything like that. It was just ridiculous. So I have never seen a winter like that in Ohio ever. So that's also going to be something interesting to continue to watch to see how that develops. Those usually years like that, a lot of things don't get killed off, and you run into diseases and crop diseases as well. So there's a lot of risk out there. and the prices are really low. So let's continue to watch that. Kevin and I will keep you updated on the commodity report, which is every week. We've been doing these around noon. I think that's a good time for us. So please check out our YouTube channel. I know everybody, we're almost at 500 people on Twitter right now. There's like 3 or 4 on YouTube. Make sure you get to our YouTube channel. There's a lot more stuff on there, and you can go back through all the commodity reports that we put out and see that we've been pretty spot on. I don't like to say, hey, we know everything, because that's not true. That's not how markets work. But our analysis has been pretty spot on. We've been pretty level-headed about it all, and it's been moving forward. And I think people have been able to position themselves well listening to it. So hope you guys have a good week, and we'll see you guys next week.